Good afternoon, everybody. Thank you genuinely for taking the time to come today for our quarterly update. Welcome also to those of you who are dialing in online. We're running a concurrent webinar, so thank you for joining us. My name's Belinda. I'm a principal in the corporate tax team here at RSM. Just some housekeeping to begin with. So the bathrooms are just out the front door, to the left for the women and to the right for the men. I'd like to formally begin our session with an acknowledgement of country. We acknowledge the traditional owners of the land and waterways on which we gather today, the Yagara and Turrbal people, and we pay our respect to elders past, present and emerging. Today's session's taking a slightly different format from our previous updates in that we have a few new speakers with us today, and we're also going to delve into a few topics in a bit further detail. Just so we don't miss anything, we'll make sure that we cover off any of the key updates from the last quarter in our next session, which will be in October. So to introduce our speakers, firstly, we have Adam Reid, who's joining us from the ATO. Adam is a director in the International Support and Programs team, and he deals specifically with the Pillar 2 implementation. He's going to give us an update on where things are at in relation to Pillar 2. We also have joining us on Teams for the first time, John Bland. John joined RSM in early July as part of our international tax and transfer pricing team. He has close to 40 years experience specialising in transfer pricing across professional services, and he's also spent several years at the ATO acting as a competent authority. We're incredibly lucky to have John, and we're looking forward to his presentation. Sam will also be speaking. Sam leads RSM's indirect tax practice and has over 15 years advising in this area. He's also a member of the ATO's GST advisory body. So Adam, I'll pass over to you now to begin.
Thank you. As mentioned, I work in the Pillar 2 implementation team within the ATO. So I'm just here today. I'll just gone backwards, sorry. So these are just a few of the topics I'll cover today. It's quite a big new initiative, so I'm not going to be able to get into a whole lot of detail in any sort of one topic. I guess what I'd really like to just cover is just to give you an overview of what Pillar 2 is, what the rules look like, where it's up to in Australia, so where the legislation's at, where the ATO is at in its preparations, and just at the end, what companies can do to try and get ready for Pillar 2. And I guess I'll just start by saying that there is primary legislation in Parliament at the moment. There's subordinate legislation that is still to be introduced. So we don't have law as yet. So there's still a few things to be confirmed. But there are some avenues for you to ask questions of the ATO, which I'll go to. And we're also commencing an EOI process for consultation coming up. So I'll mention that at the end. So the purpose of Pillar 2 is basically to try and stop the race to the bottom with corporate tax rates internationally. So to try and set a floor of 15% in every jurisdiction to try and minimise the incentive for profit shifting. So it's made up of a number of components. So the subject to tax rule, I won't cover in a lot of detail today. That's around transactions and mainly for the benefit of developing countries. What I will cover is what's called the GLOBE rules, which is made up of the income inclusion rule and the undertax payment rule. And this is then supplemented by domestic minimum tax. So the income inclusion rule is basically where there is undertaxed profits in another country. The head entity globally, that jurisdiction has the right to tax it under the income inclusion rule. the undertax profits rule is basically a backstop rule. So if the IAR isn't invoked by that jurisdiction, then other jurisdictions then have the right to try and claim that tax. And then the domestic minimum tax is, as the name suggests, it's something that's implemented in the local jurisdiction. So, and that the goal is to have that qualified by the OECD. So it is recognised as a domestic minimum tax. And I'll just skip to the next slide, which sort of ties it all together, these three taxes. So the domestic minimum tax gets the first right to tax any undertaxed profits. So if the tax rate is 10%, there's a 5% tax amount that could be claimed. If that jurisdiction has a qualified domestic minimum tax, then they can tax that amount. If that jurisdiction doesn't have a qualified domestic minimum tax, then the jurisdiction of the head entity or the home jurisdiction then has the next right under the income inclusion rule. And if that isn't claimed by that jurisdiction, then it goes to the undertax profit rule for other jurisdictions to tax that amount. So just to give a brief update on where Pillar 2 is at within the Australian context. So I guess the first official part was last year's budget in May. That's when it was announced by the government that we would be implementing Pillar 2. That was followed by some consultation that was undertaken by the ATO. The rules are scheduled to be implemented from 1 January this year, so that they are in effect once legislation is passed. There was an exposure draft issued by Treasury in March, and they then consulted on that exposure draft and received feedback, and that led to the development of the legislation and then the introduction of the legislation into Parliament in July, so last month, so still very recent. As I mentioned before, there's subordinate legislation which is still to be introduced. In terms of the timing of when or if that will be passed, that's, I guess, up to Parliament, and we sort of can't really sort of control that at this stage. Just at a high level, I guess some of the thresholds that need to be met for a global group to be in scope. So the first one is it has to be a multinational group. It has to operate in at least 2 jurisdictions. Following that, there's a monetary threshold, so it's 750 million euros per year. So that at the moment translates to about 1.2 billion Australian dollars per year. So similar but slightly different to the threshold for a significant global entity, which is $1 billion Australian. And there's that further requirement initially whereby the group needs to be in scope at least 2 of the 4 years preceding the first year. Once those thresholds are met, there are a range of excluded entities which are listed up there. So government entities, pension funds, investment funds, real estate investment trusts. There are definitions behind these things in the legislation and in the OECD model rules, which I won't go into in detail. But these are, if a taxpayer is potentially one of these entities, they will need to consider what the definition is and how it applies to their circumstances. So briefly, just going to what are the lodgement obligations behind Pillar 2. So there's sort of 2 areas of return. So what's called the Globe Information Return. So this is the detailed return that has all the detailed calculations in it. There's the ability for the group to lodge it once in one jurisdiction, and then for that jurisdiction to share that return with all the other jurisdictions who are impacted by that return. So there's a draft of this on the OECD website of what the Globe Information Return looks like, what the data points are in there. Separate to that, there are domestic forms. So this is currently being worked through by the ATO. The first point there is there can be a designated local entity which files these forms on behalf of every company or entity within that group in Australia. As part of that, there needs to be a foreign notification form. So if a group lodges the global information return in another country, the taxpayer in Australia needs to notify the ATO that that's happened. So we know that we're not expecting it in Australia, and that will be exchanged with us by the other jurisdiction. And the three returns listed there, so the income inclusion return, the under tax profit rule return, and the domestic minimum tax return. So there's no sort of decision yet on what that form or those returns might look like. It's likely that this will be consulted on in the near future by the ATO. So just at a high level, the lodgement dates, it's initially 18 months from the end of the financial year for the first year as a transition year. So if you balance on the 31st of December, then 18 months later, the first returns will be due 30 June 2026. In second and subsequent years, that will move to 15 years after the end of the financial year. So that will be end of March. And that's both the domestic returns and the global information return. It will be due at that time. So I won't go into this in a lot of detail because it is quite complex, but I just wanted to highlight that there are some safe harbour rules that the OECD has worked through with all the jurisdictions, and the ATO is looking at this as part of the subordinate legislation. I think just to mention a few, the CBC, the country by country reporting safe harbour rules, we expect that these will be used in Australia. So groups that are already reporting country by country reports, they can use that information in jurisdictions if they pass those safe harbour tests to basically to deem that there's no tax in that jurisdiction. And similarly with the QDM-TT safe harbour, if there is a qualified domestic minimum tax in a jurisdiction, then to save on doing all the calculations, they can simply say that the top-up tax is zero in that jurisdiction. So I guess just to quickly go over what the ATO is doing at the moment. So there's an area in our project team who are looking at the policies. So they're assisting Treasury with writing the legislation and the subordinate legislation. They've also been heavily involved with negotiating the rules at the OECD level with other jurisdictions. Where I work is more in the implementation side. So we're looking at the practical issues within the ATO. So the systems is a big component, building systems that can receive forms, process payments, how we store the data, how we look at it for data and analytics, how we're going to run client engagement, when are we going to follow up. Public advice and guidance is another big one. So we're currently working through the topics where we want to provide advice and guidance to the market on particular issues. As I mentioned earlier, we're also we have been doing consultation, and we're about to start another phase of consultation, and I'll have the details at the end. And we're also internally we're building people's capability to understand the new rules and what ATO officers need to do. So just a brief slide on for potential in-scope taxpayers and what they can do. I guess the big thing is determining whether you think you're in scope of the new rules. And if you think you might be, understanding what the requirements then are around filling out that global information return and what data that you need to collect to do that. Whether you can use some of those safe harbour rules that I mentioned earlier. And I suppose keeping an eye on the legislation. It's, as I mentioned, it's in Parliament now, and the subordinate legislation is to come after that. So just keeping an eye on that and where that's tracking. What I would suggest is searching. If you search ATO Pillar 2, or there's that QC. If you type that into the ATO website, that will take you to our new Pillar 2 landing page, which provides probably a lot of the information that I've spoken through today, but also some further links to the legislation that's in Parliament, to the OECD landing page, which has a lot of good resources as well. Alternatively, if you have any questions, that email address there, pillar2project@ato.gov.au, feel free to email any queries you have through there, and that will come through to us and we can respond to those questions. And finally, as I mentioned earlier, there's currently open expressions of interest to join our special purpose working group for consultation. So that closes Friday at 5 p.m. this Friday. So if you are interested, I think you need to upload a one-page expression of interest to that. Go to our website and you can upload. I think it asks you to do it to that mailbox that I just mentioned before. So, and then we'll be consulting on a range of issues, potentially the form design, topics for advice and guidance. So, yeah, feel free to do that as well. But sorry, I think that's it. But I know that was a very quick run through of something very complex. But if anyone had any quick questions, I know you've sort of got other topics to cover. But
thanks, Adam. Next up, we're going to have John, who's online. He's going to be talking about royalties in particular and the PepsiCo case, which we've spoken about before in our quarterly update, but the appeal has now gone through. So he's going to run through that in detail. I'll just follow it. There we go. I'll let you take it away, John.
Thank you, Belinda. I can also say thank you to Adam. I worked for a little while with Adam in the ATO, and the team that he's worked in has had a huge task, a massive job to implement this or bring in this entirely new system. And there's some incredibly dedicated professionals working in that team. And as I said, Adam and I work together, and I know that he's caliber. So it's going to be a good product once it's all ready. So thanks, Adam, for agreeing to talk to us today. Much appreciated. I'm going to quickly run through royalties, and you can probably tell from my voice the reason that I'm not in there is that I'm not very well, so it's probably best off that I'm at home. So, but my apologies for not being able to be there with you at the venue. I'm just trying to change the slide, and it's not quite working, Galina. Oh, there we go. Thank you. So first, a very high run through of the budget announcement, which occurred in May this year when the federal budget was announced. Some of you may remember that in 2022, there was a draft rule introduced or talked about to deny deductions to certain payments relating to intangibles where those intangibles were in low or no tax jurisdictions. That never turned into a bill and never got passed, and it looks like it's now not going to be implemented, but instead, dot point 2 there, the government's going to look closely at a new penalty regime to taxpayers who are part of a more than $1 billion group. So as Adam said before, that's our threshold for what we call an SGE, a significant global entity. That's in global turnover. That doesn't mean Australian turnover. So if it's over $1 billion turnover, you're an SGE most likely. And then the target's going to be mischaracterisation or undervaluation of royalty payments to which royalty withholding tax would otherwise apply. And you might think, well, how could that affect us, given what we do? Well, I'm going to run through Pepsi in a minute, and you'll see how these things can get quite complex, and there can be different views on the same payment about what it's characterised as. So I will now, without further ado, move on to that. If I can turn the slide. There we go. So PepsiCo was a case that was first heard in the federal court, and then was on appeal to the full federal court, and the full federal court decision was handed down in June this year. The original court was in November last year. But by way of background, I mean, we've all heard of Pepsi. PepsiCo and Stockley Van Camp are United States companies who own and operate a global beverage business, and they own the IP or the intangibles that go with that business. And you think of things like, trademarks, designs, know-how, secret formulas, marketing capability, all of those sorts of things that go into how you recognize a product as being owned or produced under the direction of the company that you recognize. And SVC, Stockley Van Camp, was the Gatorade, and I think maybe Mountain Dew was also SVC. So they own those intangibles. And what happened was, and a couple of important points in this is that the Pepsi company and SVC entered into what they call exclusive bottling agreements with Schweppes Australia. Now, first point to note is Schweppes is not a related company. Schweppes is owned by Asahi in Japan, so it's a completely independent, unrelated company. But the engagement with Schweppes, or Sapple, as we've called it there, was that Sapple would have the rights to sell sell finished goods in Australia that carried all the trademarks and the know-how and the branding and the other intangibles that went with the fact that it was Pepsi / Gatorade / Mountain Dew, all those products that we all know. So the way that it was going to work was that Pepsi and Stockley Van Camp were going to sell a concentrate to Schweppes, and then Schweppes would mix it with other ingredients in accordance with the formula, very closely monitored and know-how from the Pepsi business. Specifications were provided, formulas, all the product stuff was provided. And as part of that, buying that concentrate to turn into finished soft drinks, Pepsi also granted, and Stockley Van Camp granted Schweppes the rights to use their trademarks and other intellectual property so they could badge and make the beverages appear to be Pepsi beverages, which they were. Another important thing. So first important thing, it's an unrelated company. So this is not a transfer pricing case as such. This is a case of characterization of a payment. Takes you back to why the government's announcing this mischaracterization thing that I just said before. But in the agreement, and again, agreement between third parties, there was no express provision for the payment for the use of a royalty. In fact, the Stockley Van Camp one specifically said that there was no royalty payable, no royalty fee payable for the use of its IP. So that's the background, and we'll just move on to the next slide. And as always, a picture tells 1,000 stories. So up the top is the Pepsi and Stockley Van Camp businesses. They own the intangibles, called it IP here, but often in international tax it's intangibles. So that the curved arrow there is the EBAs that granted the rights to Schweppes to market and distribute the products in Australia and to use the trademarks and designs. But under the agreement, the payment could be made to somebody nominated by Pepsi. And so what Pepsi did was they nominated their company, an Australian resident, PepsiCo Beverage Proprietary Limited, which is the box second from the bottom, who would import the product from a Singapore company who manufactured it and then on-sell it to Schweppes in Australia. So there was no payment to Pepsi itself, although these are all part of the Pepsi group, but they're not parties to the contract. They're nominated by Pepsi to be the providers of the concentrate and to receive the payments of the concentrate. So you see, it's not by any means a simple situation, and there's payments that are made onshore, in fact, by Schweppes. So the payments are made in Australia, who then to PepsiCo Beverage, who then pay it up to Singapore. So that's the background, and again, there's a fair bit of evidence in the court about how these intangibles, how important they were and how valuable they were. There was three, just sort of a little bit of interest on the side. There's three people in the Pepsi organisation called flavour trustees. There's only three in the whole world, and they each hold a part of the formula, but nobody holds the whole formula, and they can't be on the same plane at the same time, and all this other sort of stuff. So there's no question that there's intangibles, is what I'm saying, and they're closely guarded and closely used and used to market the company and market the products. So the concentrate was bought by Schweppes in Australia and used strictly in accordance with the information and everything else that Pepsi provided it. And then they used the trademarks to also finish the goods. So I'll just move on to that next slide, if that's okay. So So thinking of that as the background, the commissioners looked at the arrangements and decided that in the commissioner's view, a portion of the payment was a royalty because there's the use of these intangibles in Australia in doing the business in Australia and selling the products, and therefore it should have been paid for as a royalty, not just as an amount for the concentrate, which is how the contracts look. Don't forget, these are big contracts. These are agreed between independent parties, battling every point and every line. They're not just like a one-page back of an envelope type concentrates contract. So they're quite complex, and every point's been fought through to get to an outcome that's happy for each party to the contract. So as part of the commissioner's audit, royalty withholding tax notice were issued at 5%. So it was deemed to be a royalty that was due to the US company, the Pepsi companies. The US treaty has a 5% royalty rate, so 5%. In the alternative, the commissioner also issued diverted profits tax assessments. And they're at a value of 40% of the deemed royalties. Diverted profits tax is a limit of Part 4A. It only applies to SGEs, which we talked before, $1 billion turnover or more. And it's where steps are taken to divert profits that otherwise would be taxable in Australia or in a foreign country. And that applies at 40% of the rate. So there's two potential avenues that the commissioner was pursuing. And the overall position for DP2 was that these exclusive bottling arrangements were a scheme that provided a tax benefit to Pepsi and Stockley Van Camp by not including separate consideration for the royalty element of the total payment, thereby avoiding the payment of royalty withholding tax. That's the position that the commissioner took to court. I'll just go on to the next slide, if that's all right. Okay, so the first court, the federal court, was Justice Mashinsky. He made a decision that he agreed that a portion of the payment should be subject to royalty withholding tax. So what he said was that the form of the agreements was not necessarily determinative of the characterisation of the payments. And here's our link back to this budget announcement, right? This characterisation of the payments is really important. And just because the form said one thing, he looked through and tried to do the classic substance over form position and say, well, the character of the payments had to be different because there were these intangibles involved and that they were fundamental to the overall agreement, and that the way that they were set up were contrived because they were said to be just concentrate alone, the product that was being paid for, whereas in substance, there was both the concentrate and the use of the property, the valuable intellectual property. So Justice Mashinsky agreed with the commissioner that it should be subject to royalty withholding tax. Now, if we go back to our picture, I won't go back to it, but remember there's no payments to the US. So how could there be a royalty when there's no payment flowing up to the US? Well, Justice Mashinsky said that the words of 128A2, where if a party deals with a payment at the direction of or on behalf of the other party, then it's equivalent to paying them. And therefore, Justice Mashinsky looked through and said it was equivalent to paying them anyway because they were paid to just the party that they directed to be paid, the concentrate supplier. And so therefore, there was a royalty paid to the US. And then what interested me was a lot of the TP concepts that we used to figure out how much that royalty should be. I won't get into it in any detail, but there was expert evidence, and the importance of experts was manifest in this case. And it was believed that 5.8% of the total payment would be a royalty. So again, the amount of the payment's not changing. It's the character of a part of the payment. The extent to which part of that payment constituted a royalty was what the court was seeking to determine. And that's what they did in this process to get to 5.88%. Justice Mashinsky then said, although royalty withholding tax applied, if he were to look at diverted profits tax, then he would also have applied that to the scheme because there was a principal purpose to obtain a tax benefit. So Justice Mashinsky, royalty withholding tax, but would have applied DPT if that was still on the table. I'll just go to the next slide. Thank you. The taxpayer, of course, appealed that, went to the full federal court, and the full federal court decision came down in June. Now, I'll take you through what the full federal court decided, but there's 3 judges in the full court, in the federal court. 2 judges were the majority who made the decision, but there's another judge, Justice Colvin, who also wrote a fairly strong minority opinion that went against these 2 judges. So the judges said that the concentrate payments were just for concentrate. They weren't for intangibles. Clearly, that's what was being bought, was the intangibles. And another important point here, this second sub-dot point, in the view of the full federal court, the grant of the license benefited Schweppes, who could exploit it in the market to build their business up. And it also benefited Pepsi by having Schweppes use it because their goodwill was grown, enhanced, sustained in the Australian market. So here's the big thing, the difference between the two courts. They're saying that there was consideration for the license of the intangible. It was in a form of not money, but of enhanced reputation to the American companies, and also in the form of building a bigger business, more penetration for the Australian companies. So they said, therefore, there wasn't a nil value of the license. They were granted for value, but value that wasn't in monetary terms, was in business building terms. So the two judges said that the commercial and economic substance of the scheme was just that the price was paid for concentrate, and that's what it was for. The money paid was for the concentrate only, and the payments were for the seller on its own account, and therefore, they couldn't be said to be substantively derived by the US company. Remember, I said before, Justice Mashinsky said, well, because it was dealt with at the direction of the American company, yeah, we can deem that to have been paid to the American company. The full federal court said, no, that's not the case. We don't accept that. It's the old legal principle, I guess, that if I owe money to person B and person B owes money to person C, and I pay person C on behalf of B, then it's equivalent to paying B, who then pays C. But what the court said was that yes, that's true, but those situations have to be what they call an antecedent requirement, an obligation. So that had to exist before any of these transactions took place, and therefore you couldn't read through the law in a way that deemed the amount to be payable up to the US. So that's where that particular approach of Justice Mashinsky was knocked over in the full federal court. If we just go to the next slide, and Justice Colvin had a separate minority judgment. So just think about it. We've had a single judge in the single court. We've had three judges in the full federal court, and there's three different opinions out of this. Justice Colvin said that the agreements were to bottle, distribute, and sell branded products. So therefore, the amounts provided for by the EBAs as the price of units of concentrate were partly amounts in consideration for the use of the trademark. So again, this is similar to what the first judge said, that there had to be a payment for the license in there of the IP. But he agreed that it couldn't be deemed to be paid to the US by paying to the person that they directed to be paid to. So that sort of has gone, that particular limb of argument. But because it couldn't be seen to be paid to the US, therefore royalty withholding tax couldn't be collected. Therefore, DPT should be applied, because the purpose of putting the structure in place with that party interposed between the contractual parties was to obtain a tax benefit, according to Justice Colvin. So in his view, the DPT should apply. He was a minority, I beg your pardon. So therefore, his view doesn't prevail. But if we could just move to the next slide, thanks, Galena. The things that come out of this are that even where there's independent parties with fully independent contracts, the Commission is willing to look beyond the form of those agreements if it thinks there's an embedded royalty or some other form of hidden amount in there that should be subject to Australian withholding tax. And it goes back to this announcement by the government that intangibles are a close focus, and they're going to continue to be that way. A couple of things to remember: if diverted profits tax applies, it's 40% of the gross amount of the payment. So in this case, the royalty, whatever it was deemed to be, the diverted profits tax would be 40% of that, even though, in fact, the withholding tax would only have been 5% if it had been paid under the US and Australia double tax agreement. So the DPT gives a much worse outcome to the taxpayer, and these embedded royalties are going to be a continuing area of focus for the Commissioner. So if we just go to the next slide. I'm not going to go through this, but you can look at this at your leisure. These are the different points, important points in each judgment, and I've just on the table on the right showed the difference between the views of the judges, and it just shows how complex this law is, how difficult it is to get an absolutely clean picture where you've got these large difficult to characterise payments. And even 4 highly qualified federal court judges have significantly different views on what the outcome should have been under this case. So I might just go to the next slide, Galina, if that's all right. So things to probably take away, things to consider are, if you've got arrangements with other parties that permit the use of intangibles, maybe you should have a look at them and see whether there is a royalty-free use of intangibles in there. Intangibles are trademarks, know-how, copyright, but it's a whole lot of things. It's know-how, it can be technical know-how that you get, it can be use of equipment, depending on which treaty we're under. There's a whole lot of things that could be royalties that you need to look carefully at to make sure that these sort of approaches couldn't be adopted. If it's all a single undissected lump sum, again, the Commissioner is willing to take that on if he thinks that there's a embedded royalty in there. And in this case, as I said earlier, even though the payment was made onshore, because the beneficial owner ultimately was going to be the US companies, can be looked through as well. At least the first court thought so, to try to capture those payments. So that's it for me. I don't think there's any more slides, Galina. But hopefully that was useful, and I think it's a sort of a presage of things to come in the tax world over the next few years about the approach to intangibles and royalty withholding tax. Thank you.
John, I was just going to ask, has the ATO appealed?
So I was just trying to find that before I came on air. I don't think so. I think the time must be up though. So what I should have said was, with all those different opinions, it's likely that the parties will appeal, at least the ATO will appeal. But you have to appeal for special leave to go to the High Court, because the High Court doesn't really want to hear tax cases unless they're, important. And this one may be, but you have to get through the special leave process first to even get into the High Court. I haven't been able to find whether they have appealed, but I would think almost certainly there will be an appeal on this one. But whether the High Court hears it, I think nobody knows.
Thank you. Thanks, John. Sam is up next with the indirect payment.
I've got quite a few varied topics to run through. So if people do have any questions, I'm more than happy to take them through the presentation rather than waiting at the end. Also, because at the end of this, I've got to jump on a plane. So happy to go through it, because I may not have a chance to catch up with people after the session. The first topic that I wanted to cover off on is some updates to GST governance in terms of how the ATO is approaching. Particularly, I'll focus, because of the nature of the audience, focusing on the top 100 and top 1,000. There are some tweaks to the next 500, the next 5,000, the top 500 programs, which are for private groups, but this is more for the top 100 and top 1,000 programs. I think in the last 2 or 3 sessions, I've talked quite in depth around justified trust and tax governance. So I won't go through, the basics. I'll assume that there's some kind of common understanding as to what a lot of these terms mean. So the whole concept around justified trust and the review programs the assurance programs that the ATO has been running has been around now for about 8 years. So 2016 was when they first kind of articulated the justified trust concept, moving away from doing specific reviews and more getting a broader level of assurance across specific areas to be comfortable that taxpayers are paying the right amount of tax at the right time. There was a refresh or an evolution of that in about 2020, which is where we are now. So we had the streamlined assurance reviews, where you had GST as kind of one stream and you had income tax as part of a second stream. 2020, they, I'll say, notionally came together as a combined assurance review. COVID kind of put paid to that. So we're probably about 2 years behind in terms of how that program is running. But this is, I guess, part of the next evolution of that program, because a lot of taxpayers, particularly in the top 100, have already been reviewed at least once. And so from the ATO's perspective, there's not as much point doing such an in-depth review of top 100 taxpayers as they did the first time around. So this is kind of working out, well, now that we come back to you, what does that next process look like? So the ATO, and I will say, sorry, that I don't have the latest stats, but I think the majority of top 100 taxpayers have been reviewed, certainly for income tax. I'm not sure that the GST top 100 program is quite as advanced. What the ATO is looking to do is to essentially move into the next phase, whereby future reviews will be more of a refresh. So rather than going in doing the whole full scale of looking at each pillar in depth, it's just trying to work out, well, what's the best approach for getting a better understanding of where things are at now, how things at a taxpayer might have evolved. What the ATO is looking to really do is try to take a lot of that burden off taxpayers. They're hearing the feedback that, look, these are quite invasive reviews. They take up a lot of time, effort, resources. So to the extent that they can get that comfort from existing data, so they'll be looking quite closely at tax returns, what are the labels, the disclosure labels saying. There is a pre-engagement process for income tax purposes, but even for GST purposes, they will be looking quite closely at the BAS returns, and particularly the labels, to get an understanding of how things are progressing within the business. They'll be using third-party data wherever those sources might be. So whether that be public information, it might be ASIC, wherever, just to get a sense of how the businesses are performing. And I guess what that will then lead into is a more tailored approach particularly for GST. So whereas previously there was, I guess, a significant focus on tax governance, where they've been able to get that level of assurance for stage 2 or stage 3, the next round won't be anywhere near as, I'll say, invasive as the first round. It'll be more around refreshing. So getting an understanding of, has the business changed from the last time? Have you bought some companies, sold some companies, put in place new software? So really getting an understanding of, okay, well, what's going to really affect the rating that we gave you last time? And let's have a look at that. But if the fundamentals haven't changed, we're not really going to focus on that again. Tax risk flag to market, so probably more relevant for income tax than GST. But if you're in specific areas which have higher risk for GST purposes, particularly where the ATO has issued a taxpayer alert, the ATO will be looking for indicators, whether that be in your tax return, your BAS returns, as to whether you're still operating within their, swim between the flags or whichever ratings, they want you to swim in. Probably the two most relevant, or probably the two areas that are going to be looked at more particularly, is correct reporting. So this goes to, from a GST context, mainly around the BAS. So if the ATO is, as part of the first review, undertaken a full-scale, BAS walkthrough, like I said, they're probably unlikely to come back and do a full-scale one next time if there hasn't been any major changes. So software updates, new businesses, different markets, that type of thing. The one I did want to flag is the GST analytical tool. So the ATO is really ramping up how much reliance it puts on the GST analytical tool. I guess I'll pause there just in case people are or aren't familiar with what that is. People, just very briefly, essentially what the ATO is wanting taxpayers to do is a reconciliation of the revenue and expenses reported for GST purposes on your BAS compared to your financial statements. And look, appreciating there are timing and permanent differences, but effectively what the ATO has out there is a methodology, the GAP methodology, and they are really wanting taxpayers to use it. So as part of the first round of reviews, it's a mandatory requirement, so you have to do it. As part of the second refresh, the ATO will generally not require it as anywhere near as to be completed anywhere near as in depth, but there's still an expectation that you're kind of doing it and maintaining it. So for those who either aren't familiar with it or haven't decided to do it, really the key message is ATO is effectively making it mandatory for top 100 and top 1,000 taxpayers. Which does make it difficult for groups that have a large number of entities, or where there are differences between what your accounting groups look like versus what your GST groups look like. So just to summarize, and this is more relevant for the top 100, I'll get into the top 1,000 in a second. One of the things, actually, this goes across all review and assurance programs. One of the things the ATO has noticed, and they're very happy and pleased when they do see voluntary disclosures, that there'll be a notification saying, hey, you've been randomly selected for a review. Take the opportunity, have a look at your systems, your processes, your historic returns, whatever. And if you find any errors, let us know, and we'll treat you leniently. And around 40% of the time, the ATO gets a voluntary disclosure. And generally speaking, they'll take it at face value, they'll have a look at it and go, yep, that's great. Thank you very much for that. They come back again in 4 years. They haven't heard from you, but in 4 years' time, they lob another, hey, we're doing another assurance review. Oh, 40% of the time again, taxpayers are lodging voluntary disclosures. And they're saying, okay, so the only times that people are doing voluntary disclosures is when we, send you a notification. What's happening in the bit in between? So what the ATO is really, I guess, focusing on, or at least has an eye on, is, okay, well, you managed to find errors when we tell you to go have a look, but in between, what are you doing? And so they're going to have more of an idea or more of a focus on looking at your returns, or at least questioning you more often to go, have you done a voluntary disclosure, or do you need to do one? Are you making VAS amendments? They're actually good signs that you're continually looking at things. So I think in the minds of some clients, they think, oh, if I make a voluntary disclosure, I look bad. Actually, it's not a bad thing, because the ATO is saying, well, that gives us real-time comfort that you have detective controls in place to make sure that you're paying the right amount of tax. So just bear in mind that, in the top 100 and top 1,000 space, that the ATO is expecting kind of continual adjustments, because if the only time you're doing voluntary disclosures is when the ATO is reviewing you, may not be the best look. So just to kind of wrap up the top 100, what the ATO is saying is, if previously you've had a medium or high assurance rating, it's going to be a relatively light touch. It's going to be more of a monitor and maintain process. Whereas if you've had a low assurance rating, effectively you go back to the start. You've got to do it all again. You've got to assure them, and hopefully you get a better rating the second time around. It'll be relevant for both top 100 and top 1,000. The ATO is consulting at the moment around requiring larger taxpayers to prepare annual GST returns. So not specifically, not BAS numbers, but actually a return which provides information on governance and justified trust. So all of those, sorry, wrong button. Yeah, so those 4 pillars there of tax governance, tax risk flag to market, correct reporting, GST analytical tool, are likely to be the subjects of this new annual GST return. So effectively, where the ATO has already come in, done its reviews, had a reasonable level of assurance, so that they don't get surprised 4 years down the track, they're expecting disclosures in respect of those kind of 4 headings. The details of exactly what the return is going to look like, and the details of the specific questions or the depth of which the disclosures, that's still up in the air, that's still being consulted on. But bear in mind that that's likely to be a new lodgement requirement relative to relative to what you're currently doing. So likely we're going to see some details of that in the next kind of month or two. So just moving on, sorry, I hit the wrong button. Oh. So just moving on to top 1,000, and there was an announcement a couple of months ago that the kind of metrics as to who falls within the top 1,000 have changed, and that's just a function of, well, we probably say inflation, because at the moment it's set, the bottom benchmark is 250 million. So at the moment, 250 million, you're considered to be top 1,000. And the ATO has always kind of wanted to focus on 1,000-ish taxpayers in that group. Whereas now, since that threshold was set, there's about 1,500. So the ATO doesn't really want the bottom 500 in the top 1,000 group. They want them somewhere else. So they're just shifting the 350, or moving it from 250 to 350 to just really focus on that 1,000 group. And what they've also done is differentiate within that top 1,000 group, the top 300 of that top 1,000. And the reason for that is the top 300, who they will call the significant pool, they are essentially at that $1 billion threshold, which we've heard before is the significant global entity threshold. So they get kind of special treatment, but it's, I don't know, bad special, not good special, because there's a higher level of expectation on that top 300 because they are significant global entities, high turnover, and in terms of dollar values of what they contribute to the Australian economy, a relatively higher proportion compared to the rest of that population. So there will be a higher threshold in some respects if you're in that top 300 of the top 1,000, which excludes the top 100. So similar to what we were talking about before in terms of what the ATO is looking to do for the future, is that once you've had your first review, if you've had a good rating of stage 2 and stage 3 in terms of governance and a medium or high level of assurance for GST, then essentially the next stage or the next review will be more of a kind of refresh and focus on specific areas. So again, if you've had some major changes to the business, software implementation, new markets, whatever it might be, they'll be kind of focusing on that as opposed to kind of redoing everything from the start. But if you haven't had a good enough rating the first time round, so stage 1 for governance or a low assurance rating, you go back to the start. You've got to redo the whole thing until such time as the ATO is happy and gets you back into that stage 2 or 3 rating and a medium or high level of assurance. Any questions on governance? I know I've kind of raced through quite a lot, but happy to talk either in this forum or separately. No? So the last ATO meeting was back in March. Actually, there was one last week, but the minutes haven't been released, so I can't really talk too much about that one. So the only couple of things, there weren't really too many things of interest to this group. The only couple of things I just wanted to flag is that the ATO is, as much as it feels like the ATO is just kind of focused at the top end of town, and to be honest, it probably has for the last kind of 5 to 10 years, there is a bit of a refresh going on to focus on small and medium businesses and also the micro businesses. So those are businesses that are essentially less than $75,000 in turnover annually. In the sense that if you stand back and think, well, what's the total debt owed to the ATO at the moment? Look, the numbers kind of change all the time. It's somewhere around $60 billion, which is up from about $30 billion pre-COVID. And of that $60 billion, people are surprised to learn about half of that is small business. So notwithstanding that kind of big taxpayers get all of the focus, small taxpayers are actually the ones with the largest amount of debts relative to the amounts they contribute. So there is a bit of a focus on how to improve the tax performance of small businesses without kind of being aggressive and kind of taking them to the wall if they're a minute late for their tax payments. So there are various kind of programs going on. They're more in the nature of, I'll say, nudge programs, just trying to help behaviour as opposed to more of the sledgehammer approach that they've taken to the top 100 and top 1,000. So things like what they call right time reporting. So at the moment, if you're a small business, you can report, and generally you do, report on a quarterly basis. They're kind of nudging taxpayers to say, look, you don't have to, but why don't you start lodging on a monthly basis? It's going to help you from a cash flow point of view. You don't have to keep the money in your account set aside, and occasionally you might end up in working capital. And what they found is that even though small businesses aren't actually required to lodge monthly, 75% who've gone through the program have said, actually, this is actually pretty good for us, and it helps us manage our tax a lot better. So there's that. There's trying to align what the ATO call natural systems or natural business systems to tax. So a lot of the times, record keeping and just making sure that they have all of the substantiation is more difficult in smaller businesses. So they're saying, well, how can we use records that just automatically get created better to ensure that, one, you pay tax, and two, you get the right deductions and you get right input tax credits. So there's a bit of work going on, particularly with digital service providers, to say, well, how can we embed kind of tax in things like FPOS machines or, other third-party facilitators so that tax just kind of naturally happens as opposed to being a pain point for small businesses. And I'll come back to it in a second, but the sharing economy reporting regime is kind of an element of that, of using third-party data to make sure the right amount of tax is getting paid. In terms of the ATO Forward Work Program, things that the ATO is looking at is, again, kind of looking forward to 2030 and, tax just being a lot more digital than it is today. How can they use existing data for tax purposes rather than having to create GST data? So, one day potentially BASs disappear because you've already got the transaction data sitting in an accounting system somewhere. So if that accounting system can just kind of magically send the data to the ATO, or it just happens naturally, great. So there's a bunch of other countries doing way more advanced things than Australia that are being looked at. E-invoicing mandates, that's also on the agenda. So the ATO is obviously aware that other countries are way more advanced in terms of mandating the use of e-invoices, particularly to substantiate GST and input tax credits. So just kind of looking at the lived experiences of other countries before really just starting to push hard as to whether or when that happens in Australia. It will happen, but when, no one's really known. And the sharing economy reporting regime. So for those who aren't aware, and there may not be too many in the room who are directly affected, but if you are what's called an electronic distribution platform, essentially any type of website portal that facilitates a transaction between a supplier and a buyer. And I guess, simple examples would be, the Ubers, the Airbnbs, they don't actually own the goods that are being used, but they just facilitate a transaction between two other parties. So what the ATO is fully aware of is the fact that, you have a multitude of suppliers, and potentially not all of those transactions are being captured for both income tax and GST purposes. But the data for all those transactions actually sits relatively centrally held with the platform provider. So the ATO is, well, not the ATO, but the government, as of 1 July last year, implemented a reporting regime. For those familiar with things like TPAR, it's not dissimilar to that, where you're reporting other payments that are being made. Last year was for things like Uber, so taxi travel, ride sourcing, and short-term accommodation, so Airbnbs, that type of thing. As of 1 July this year, it's effectively all transactions that are facilitated through an EDP, website, portal, whatever you want to call it, that is not effectively just for goods. So, once you kind of remove the likes of eBay that are selling goods, any other type of website that facilitates effectively any other type of supply is caught unless you can find a way out. So there are transactions that have already happened in the last month that will need to be reported. The reporting periods are every 6 months, as you can see up there. So you effectively get a 6-month reporting period, and you've got to the end of the next month to then lodge your report. There's a standard format, an XML file that needs to be prepared and then lodged directly with the ATO. There are a few exceptions as the types of transactions that don't need to be reported. So anything that involves the actual sale of goods. So, if you're on, I don't know, Etsy, eBay, whatever it might be, and you're selling something physical, that's not what this is intending to capture. However, if those sites are facilitating a transaction that involves a service, advice, an intangible, a royalty, whatever it might be, something that is not goods, that is captured. Anything that involves the transfer of land isn't captured because there's other data that exists elsewhere that already captures that. So, titles office, for instance, and financial suppliers, because there's no real GST involved in those transactions. There is also exceptions for where transactions involve multiple EDPs. Now, you might think that that's not common, but surprisingly it is. So you might be booking on hotels combined, which then is searching what if, which is then searching someone else. You can have a multitude of EDPs involved in the actual physical delivery of one hotel room. In that case, only one of the EDPs needs to do the reporting, not all of them. Certain types of suppliers, so if you're a large supplier, so if you're listed, Yes, if you're an EDP, but your supplier is a listed entity or a wholly owned subsidiary of a listed entity, that's not a transaction that needs to get reported. Or if the supplier is is making $1 million worth of sales through your EDP, you don't need to report those transactions. We've gone through the types of suppliers as well. So there's a number of different elements that need to be considered as part of this. So, what does an EDP mean? Like I said, it's actually much broader than you might think. So you might just have a website that you host to, facilitate in the local area 3, bed and breakfasts, down the road. Well, actually, you're an EDP because you are facilitating someone else making a supply to an end consumer. So we're not talking about necessarily about the big platforms anymore. We're talking about any platform. Anyone who's facilitating someone else's sale is potentially caught. There are exceptions and carve-outs depending on which way or whether the EDP is involved in collecting payments. And is the supply made through them, which is very different to saying, hey, I host a website where I put a list of bed and breakfasts on there, but that's it. Like, I don't actually facilitate the transaction. I don't collect the money. I've got nothing to do with invoicing. So there's still an element of the supply has to be made through the platform as opposed to just being listed on a platform. The type of transactions that need to be reported are only those ones that are connected with Australia. So if it's a non-resident selling to another non-resident, it's not included. And also, obviously, we just went through the exceptions or the exemptions that can apply. And very briefly, there are a range of, all of the states have just gone through their budget process, I think with the exception of Tasmania. That's to come next month, I believe. Look, there's a whole bunch of changes that were made, predominantly focused around first homeowners. I'm not going to go through any of those because there were, one, a lot, and two, I wasn't that interested in them in the first place. Probably the ones to be mindful of, there are increases, particularly in Queensland and New South Wales, to surcharge rates. So these are the rates that apply to either buying dutiable property or holding land that might be subject to stamp duty or land tax. Interestingly, Queensland raised its surcharge rate from 7% to 8% because it wanted to bring itself into line with New South Wales. And then a couple of weeks later, New South Wales went, nah, we're going to change ours to 9%. So I guess wait and see. Queensland will raise it to 9% next year, probably. And the surcharge land tax in Queensland went from 2% to 3% because they said, well, still lower than everyone else. And then New South Wales went, okay, fine. We're going to change ours from 4% to 5%. So you can see it's so far, all of these surcharges have only ever gone in one direction. The definition of foreign person, for those who've not had the pleasure of trying to work out, is way broader than you might otherwise think. You ultimately have to kind of trace it all the way up through to individual people, really. So even though you might have a series of Australian holding companies, if at the end there's a foreign person, individual involved, then potentially you're a foreign entity and these surcharges may apply. And particularly in Queensland where you own land, that can be onerous because the surcharge in Queensland relative to other states for land tax is on any type of property as opposed to just being on residential property, which, when you think of the rationale was to increase housing stock for local people instead of foreigners, but you then tax commercial property. I'm not sure how that works, but anyway, New South Wales has, so a few years ago, they indexed their land tax thresholds and the premium rate threshold for land tax also to keep track of inflation. But effectively what that means is because those thresholds were going up, that less tax was being collected because they were just kind of maintaining, whereas now they've gone back to fixing those thresholds, which means that the value of land will continue to go up, as will your rates of land tax, but your threshold is going to stay where it is. So this is just another way of collecting more money. But that does bring New South Wales into line with everyone else who don't have indexed thresholds. Look, there are some changes for GPs. So for those who have paid attention, there was a series of court cases which ultimately concluded that payments to general practitioners and other type of allied health professionals were subject to payroll tax or could be. That all kind of blew up in the media and everywhere else. So they've implemented a range of different rebates, exemptions, amnesties to kind of placate GPs until the next round of elections are done, and then those rebates will disappear. So there are some different changes that have been put in place, but they're all relatively temporary, with the idea being that that gives GPs and others enough time to kind of restructure their affairs to be in line with what the courts have held. Payroll tax for Queensland, there is a regional discount where you have a workforce that is predominantly regional, so 85% or more, I think, is the magic number. There is now a cap on that, so if you pay more than 350 million in wages, the regional discount doesn't apply to you, but unless your name is Glencore, then this isn't relevant to you because that was essentially just them. So I think everyone else is okay. The rebate in Queensland for trainees and apprentices will continue for another year. I think that's just like a rolling thing. They keep extending it for another year, so that's been around probably 10 years. They kept extending it. There's been a couple of other surcharges that have been implemented for large taxpayers in both ACT and Victoria. Victorian payroll tax threshold has gone from 700,000 to 900,000 this year. It'll go up to $1 million next year. So they always had the lowest threshold, so it's now starting to move, thankfully. We haven't covered it in any great detail, so I'm happy to talk to people who do own land in Victoria, but there is a commercial and industrial property tax that is now in place as of 1 July this year. There's a transitional period that runs for 10 years, during which period there'll be one last round of stamp duty, and then after the 10-year period, there'll be no more stamp duty on commercial industrial property, but there will be an annual property tax that will be levied based on a percentage of the value of the land. And the last thing I wanted to flag, and going back to a previous session, I think it was about 2 or 3 ago, where we talked about the Vanderstock High Court decision and how that effectively made a whole bunch of state taxes potentially unconstitutional. WA had sought to implement a similar EV charge for use of electronic vehicles. That's now been discontinued. They haven't really given a reason, but I think you can probably tell that it's no coincidence that it happened after the Vanderstock case came out and said Victoria's was unconstitutional, so presumably WA's is as well. And that's it. So any questions on the indirect tax update? Otherwise, I'll hand back to Belinda. Just raise GST to 15, it'll be great. Exactly. So yeah, I think we're still waiting on any response really from any level of government as to what happens next. But thus far, the only change that we've seen at a federal level in respect of any of these cases has been around reinforcing the validity of the foreign surcharges at a state tax level. So I think there is still a case happening at the moment. There's a class action being taken by a group of foreign entities that have been imposed surcharges to see whether that is constitutional. But I think the federal government implemented some laws to kind of tighten that up. So I suspect the challenge will fail, but yeah, we'll see.
Thanks, Sam, and thank you everyone for your attendance. I'm not sure if there's any last questions before we wrap up. No, thank you. So we will circulate the slides. The ATO has requested that we not circulate their slides, so the pack will come out, but it won't have the ATO slides. We will, however, provide that contact information that they included there. There'll also be a link to the recording and a feedback survey. So we would appreciate if you could take a moment to fill that out. But yeah, thank you again for coming, and we'll see you next time.